Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank in Singapore. Vishnu, thanks. As always, great to have you on the show.
Always a pleasure, Brian.
Now, Vishnu, let's start by taking a look at how regional markets are performing. The Bursa Malaysia FBM KLCI is at 1,525.52. It's down 0.4%. The SGX is at 3,143.41. It's down 1.48%. Across the region, we've got the Nikkei, which is at 28,328.51. It's down 1.1%. The Shanghai Composite is at 3,545.65, up 0.44%. The Hang Seng is at 27,865.25. It's down 0.74%. And rounding up the numbers, we've got the ASX 200, which is at 7,311.3. It's up 0.68%. Now, Vishnu, Asia Pacific markets are mixed. We also had Chinese electric car maker Xpeng fizzling on its Hong Kong debut. What is your view on how markets performed in the first half of the day?
It appears that markets are on a very cautious tone. We can throw out many reasons for it. Some can say they're anticipating the details of the FOMC minutes to see whether there are any more hawkish flavors that they've missed out on there. Equally, it could be the softer than expected US ISM services data that suggests that consumer spending is not quite as strong as suggested, and that has also trickled down to weaker orders in Germany, and we've got China in particular that continues to tighten some of the regulatory credit aspects in its approach to the property sector and parts of the tech sector, whether it's data management or the platforms. So these are a mix of factors, giving cause for markets to pause, perhaps recalibrate and see whether they've gone out too fast and whether they've underassessed some of the lingering risks.
Now, Vishnu, the tech clampdown on data in particular and the very broad wording is actually worrying markets, isn't it? Because essentially one of the key challenges is the implications of that, particularly in Hong Kong, is the fact that basically the tech giants who have staff in Hong Kong could be under, depending on interpretation, subject to very significant scrutiny, perhaps even arrest. So I think that's particularly something that's weighing in on the tech giants and therefore may, in fact, force them to leave the market.
I mean, that's certainly something that's, like you pointed out, it's not entirely clear now. So the lack of clarity around it is really weighing on markets. And the thing about Beijing is this. So there's a very open recognition that in terms of the tech space, a lot of the platforms and the other aspects of it, there is a required regulatory catch-up. And I think the tech sector now perhaps begrudges two things. One is Beijing could catch up a lot faster compared to its international peers, hence not only depriving it of any advantages, but perhaps putting it at a disadvantage. So that's one factor. The other factor is nobody knows what form this regulatory catch-up will take, how hard it's going to come down on them, and what it means for Beijing to level the playing field, and whether or not SOEs will be involved in the process. So there are many degrees of uncertainty, and I think that's why the tech sector has turned rather cautious, taking a leaf out of Didi and before that Baba as well.
Yeah, but also one of the things with Didi and Baba, specific examples, they actually have a very large foreign shareholding and are listed overseas. So I think perhaps there's two standards here.
I mean, there certainly could be, but there's also a very clear sign that and this is where I think it gets a little bit confusing for markets trying to interpret it. While Beijing definitely wants to have tech leaders out there in terms of getting the technology, the platform, so on and so forth, they are also reining in how much information and power these companies can wield. So it's a very delicate and balancing act for any tech company, and I think that's perhaps a bigger worry than is perhaps the uneven standards onshore or offshore.
Now, let's move on to oil markets because the OPEC producers canceled the meeting where they were supposed to uh, uh, meet together, decide on whether or not to increase supply, given the fact that prices have run up, but they canceled the meeting. So prices have corrected. What's your view on the prices of oil, given the likely pickup, especially on the demand side, as travel is starting to open up, and of course, global economies are starting to pick up?
I'll be the first to admit that actually the underlying, the underlying drivers for oil are pretty much in line with other commodities. And if anything, if we peg oil prices and other commodity prices back to pre-COVID, oil has underperformed all the rest. So certainly there seems to be room to catch up. And as you point out, especially when travel resumes. That said, we do have a good part of OPEC capacity, idle capacity that is, as we have found out from the disagreements, that is dying to be tapped. A lot of the OPEC producers are hurting. They want to produce a lot more. And let's not forget that US shale is by the sidelines, but not buried. If prices do rise in a sustained manner, shale will also make a comeback. And Iran is already trying to play the nice tune, saying that, look, they can also add to global exports. So our sense is that oil prices will be buoyant, but they're certainly not going to go to the type of exuberance you see at $100 and $120 per barrel kind of area. So a lot of it will be dampened. And on the demand side, what will help to dampen is the fact that the recovery is certainly taking shape and unfolding, but it's not unfettered. So along the way, you're going to see it bumpy, and so that's going to check prices on the upside.
Vishnu, I want to ask you about the shale producers because they were always the swing sort of number that could come in when prices hit a certain mark. But one of the things that has changed, particularly in the last 2 years, is the fact that shale production is now seen as a dirty word. In the ESG space, that's a dirty word. Is the fact that the difficulty in shale producers in getting financing going to be basically the spanner in the works for shale production?
I mean, that's a fantastic point. And in fact, you are right. Shale used to be a real cash-driven game. So as long as they could get cash, they would pump. And this is what led to them being able to pump at far lower prices than anyone thought possible. So what has happened is, like you rightly point out, with the finance part of it starting to tighten, the shale viability has migrated from the so-called top line, how much they can produce and sell, to the bottom line, the profitability of it. And so those who are already invested, yes, they could have some trouble with the cash flows, but when prices get to a point where it's profitable, I think the allure is going to get them to come back anyway. And I do see the point that shale is incongruent with ESG. But the reality is, and I may get whipped for this, is that ESG, as sexy as it is not the only game in town. And for a long time more, we are going to still rely on fossil fuels. And so the extractive industries, as much as they need some soul searching and rethink, we are all complicit in this. They're not going away yet. They're just finding alternatives to hedge.
And people go where the money is.
Thank you, Brian. You took the words right out of my mouth.
Thanks for your insights, Vishnu.
My pleasure, Brian.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out our website, biztech.asia, for business and technology conversations. And please subscribe and like our Facebook and LinkedIn pages as well. Thanks a lot for tuning in.